Hi, my name is Marc Chapman, manager of the HI Principia European Equity Fund. Looking at the recent performance, we see a continuation of a difficult period which started in September of last year. Essentially, the European market has been driven by flow out of mid-cap European equity and more into defensive large-cap names. This impacted the fund in December like it has in previous months, and so we saw a decline in the NAV. In particular, on individual stocks, Fresenius Medical Care performed badly during the month with a revision downwards of returns estimates. The positive contributors came from sector baskets, a healthcare short basket and also a small cap basket. Looking at the macro data in general, we see deterioration. In the European PMIs, there seems to be a softening, and the news flow out of Asia seems to indicate that the Chinese economic growth is now starting to struggle. More specifically, in the technology sector, inventory levels have been rising for the past few quarters. So Texas Instruments have seen historically high levels of inventory in the past quarter, and Apple has recently reported weak volumes driven by consumer saturation and probably a more difficult pricing environment. However, in terms of earnings estimates, they've been revised down over the past couple of quarters, and we now see some sign of stabilization. And on valuation, in particular with growth stocks, they've been marked down materially over the past 6 months, which has meant valuation levels now are looking much more reasonable compared to 12 months ago. In terms of portfolio construction, we are focusing on individual names which can resist the general pressures that are going on in the economy at the current time. I would highlight Sulzer in Switzerland as one such name. The company is world leader in pumps for oil and gas and for general industry, and we believe their order intake and demand environment will continue to remain solid, and this will drive a margin improvement and good cash flow over the next couple of years. Other names in the long book are mainly healthcare orientated names where we see a more defensive earnings profile. In general, the risk reward is more skewed to the upside given the negative sentiment currently existing in the market and also the relatively attractive valuation. Thank you very much.